You've probably seen the charts with lines, indicators, and patterns that look like something straight out of a financial wizard's playbook. But here's the thing. Does technical analysis really work? Or is it a bit of a trap we fall into as traders? I mean, think about it. If it were so foolproof, wouldn't everyone just be raking in the profits by now? If you've ever had that feeling where the market seems to know exactly where your stop loss is, or a perfect setup suddenly turns into a nightmare, you're not alone. Today, we're going to pull back the curtain on the dark side of technical analysis, because let's be real, it's not always the magic formula it's cracked up to be. It's all hindsight bias. Ever noticed how everything seems obvious in hindsight? After the fact, technical analysis makes everything look neat and tidy. Like, oh yeah, that was clearly a head and shoulders pattern. You feel like a genius after the move has already happened, right? But when you're in the moment trying to trade it live, it's never that clear. You know what's funny? Traders love to pull up charts and say things like, I knew this pattern was forming all along. Sure, but they say it after the market moved. This hindsight bias at its finest. You can only identify a perfect setup when the trade has played out already. You spot what looks like a double bottom and think, this is the reversal. You're hyped, you enter the trade, and just when you're ready to celebrate, the market blasts through that solid support like it was paper. What happened to your double bottom? In hindsight, you go back and see, oh, that wasn't a valid double bottom after all. Now you're left scratching your head, wondering why it looked so obvious after you lost the trade. It's easy to forget that we're looking at historical data on a chart. The candles that haven't formed yet, that's where the real challenge is. And technical analysis can make you feel like you missed something only because you can see the entire story now. It's like watching a replay of a sports game and saying you predicted the outcome. It doesn't really count. It ignores the bigger picture. Here's another big issue. Technical analysis is often like tunnel vision. You get so obsessed with those lines, patterns, and indicators that you completely ignore the bigger picture. It's like standing so close to the TV that you can't see the whole screen. You're caught up in the tiny details, and you miss the news bomb that's about to drop. Let's say you're deep into your chart, plotting those Fibonacci retracement levels to the exact decimal. Meanwhile, the Fed has just cut interest rates, or there's a political event brewing that's going to send shockwaves through the market. But there you are, staring at your perfect setup, and bam, the market moves in a way that your lines didn't predict. Suddenly, your Fibonacci looks as useful as a fortune cookie prediction. The thing is, technical analysis tends to forget that real-world events move markets, not just price patterns. That's why, no matter how clean your chart looks, news can and will crush your setup. So, while you're drawing those lines, just remember, the market doesn't care about your chart. It reacts to real events, real decisions, and real-world actions. Too many indicators, too much confusion. Ever heard the phrase, less is more? Well, in trading, that couldn't be more true. But for some reason, we all love to clutter our charts with indicators, thinking it will give us more clarity. RSI, MACD, Bollinger Bands, moving averages. I mean, at some point, your chart starts looking like a piece of abstract art. The irony? The more indicators you have, the more confused you get. One says buy, the other says sell, and you're stuck in a weird limbo where you don't know what to trust anymore. It's called analysis paralysis, and it's real. Let's say your RSI is telling you the market is oversold. Time to buy. But then your moving average crossover says, wait, hold up. It's a sell signal. Now you're frozen. Do you buy, sell, or just do nothing? You end up overanalyzing to the point where you miss the move entirely or make a decision out of frustration. The truth is, these indicators are based on price, and they tend to lag behind. So by the time they're signaling something, the market may have already moved. It's like driving a car while looking in the rearview mirror. You're analyzing what has happened, not what's happening now. False sense of control. Here's a tough one for us traders to swallow. Technical analysis gives you this false sense of control. It makes you think you've got the market figured out, that you've cracked the code. But honestly, no one can predict the market with 100% accuracy. You're making educated guesses at best. You see a clean trend line forming over days. You're confident. You're ready. You place the trade, convinced the market will respect that trend line. But then, out of nowhere, a random geopolitical event, something you couldn't possibly predict, smashes through your trend line like it wasn't even there. Just like that, your plan goes out the window. It's this illusion that you're in control that leads to overconfidence. You start believing you've got the market figured out, and that's when it slaps you in the face. The market doesn't care about your technical setup. It's a living, breathing thing influenced by millions of factors that no chart can predict. So yeah, technical analysis isn't as bulletproof as some traders like to believe. It can feel like you're trying to solve a puzzle with missing pieces, and sometimes it's straight up misleading. But here's the thing. Just because it's flawed doesn't mean it's useless. The trick is figuring out how to navigate these pitfalls without falling into them headfirst. So, what can you actually do to avoid getting burned by your charts? Let's talk about a few ways to make technical analysis work for you instead of against you. Combine fundamentals with technicals. One way to cut through the noise is to pair technical analysis with fundamental analysis. Don't just rely on charts. Keep an eye on what's happening in the real world. Think of it like a combo meal. Technicals are your fries, but fundamentals? That's your main course. When you bring fundamentals into the picture, you're adding context to your technical analysis. That trend line might hold, unless the Fed makes an announcement that changes everything. By combining the two, you're giving yourself a much clearer picture of the market. Simplify your strategy. Here's a radical idea. Simplify. Instead of overloading your charts with 10 indicators, try stripping it back. Less is more. Focus on one or two things you really understand and trust. It might be price action and one indicator like RSI. That's it. Clarity over complexity. When your charts are clean and your strategy is simple, you can make faster, more confident decisions. You're not bogged down by conflicting signals or overloaded with information. Simplifying your strategy could be the best decision you make as a trader. Accept that you can't predict the market. This one's tough. Admit you can't predict the market. I know it sounds almost like giving up, but really it's about shifting your mindset. The goal isn't to be right all the time. It's to manage risk. Focus on protecting your capital, not trying to nail every trade. Stop trying to be the market wizard who always calls the top or bottom. Instead, be the trader who stays in the game for the long haul by managing risk and keeping your losses small. At the end of the day, that's what separates successful traders from the rest. Technical analysis isn't some magic crystal ball. It has its place, but it's not the holy grail many think it is. The market's too complex for lines on a chart to give you all the answers.